It is my pleasure to introduce the next moderator for today's panel on corporate venture capital. And with this, I will give it to Fred. Fred.
Thank you very much. Thanks so much. So nice to see everyone. I was just telling the story of how I got introduced to Angeles by Marcelo, as I think a lot of folks originally were, and to see how far the organization has gone from those early PowerPoint sketches of what the dream of this was, and how much it's all grown, and how many of us have seen each other at all the different pitch nights, whether it's Miami or in Chicago here or in New York. So it's so nice to be here, and it's really spectacular how Angeles has grown. I'm Fred. I'm the founder of a company called Venture Fuel. We sit in between large corporations and startups. So we're almost like a corporate innovation advisory, working with people like Comcast and Procter & Gamble, but really thinking about how do startups scale by working with large organizations and what's in it for both of them. And so when David asked me to host a panel, I was like, well, why don't we bring some corporates up here to do two things. One, talk to you about the investments you've already made. How can you help them work with corporates? Two, what's the value of corporates and startups working together? And then these guys are all investors also. So how do they source deal flow? How do they vet companies from that larger company lens? So that's the goal of today. So if you guys can come up and join me, I'm going to put you on the spot to introduce yourselves. And then just from a mic standpoint, should I hold this or talk through this? I don't know. You guys hear me this way or no? Use this one? Okay. All right, well, we're mic'd up in all different ways. So I'm always terrible at introductions, so I like people to do it themselves. I go for way too long. So why don't I pass it down and each of you kind of say a little bit about yourself and where you work.
Sounds good. Thank you. Thank you for the invitation. It is great to be here. My name is Elias Chavarria. I am an investor at TDK Ventures, and most people that hear the name TDK maybe sounds like, I've heard that before. Yes. If you remember the cassette tapes, many years ago, that TDK. So that TDK. So today you can think of TDK as a company that does a lot of electronic components, materials, batteries, power supplies. So it's a company that's everywhere, but you don't know about it. So TDK Ventures, we are the VC arm, the corporate VC arm for TDK. At a high level, we are deep tech investors, early stage, looking at seed to Series B, with a typical check size of up to 5 million. From my side, I'm originally from Panama. Came to the US, did a PhD, Georgia Tech, and then went to the industry, have been doing R&D, innovation, engineering, product management, and now corporate venture capital for about 1.5 years.
Perfect. Welcome.
Thank you.
Jeff.
Thanks so much for having me. Excited to be here. Josh DeFrancis. I kind of have two hats. I lead incubation venture building at LG Electronics, and I'm a partner at Nova Prime Ventures, which is our partner CVC. LG really, we're focused on, I sit in the Silicon Valley Innovation Center called LG Nova, and it's really focused on helping LG expand into net new areas, net new business models and areas of focus. We really focus on healthcare, which is most of my background, clean tech and AI. And then we look for more software-driven business models. So we actually build out new businesses. We partner with startups as part of that. And then on the fund side, we invest in those startups. My background is mostly a mix of a lot of healthcare, technology, investment, and government. I spent some time at CVS Health on their growth venture team. I was part of biotech and part of Mass General Brigham, which is a Harvard Medical School health system for a while in their innovation center. Then I spent some time in the White House leading a program called the White House Innovation Fellows. But thanks so much. Excited to be here.
Hey everyone, pleasure to be here. My name is Min Park. I'm part of JP Morgan Asset Management as part of a dedicated growth equity strategy focused on sustainability. And so sustainable growth equity, we write equity checks between 20 and 100 million. 30 to 50 is really our sweet spot, focused on companies that are helping decarbonize the industries that historically have been the most challenging to decarbonize. So areas like real estate, food and ag, transportation supply chain, industrials and manufacturing, industries that historically represent about 80% of global GHG emissions. And so they're the most critical from our estimation, but also core and adjacent to where JP Morgan has a lot of market leadership. And so we believe as an investor on the cap table, beyond our equity check, we can really drive outsized value through our broad scale and network. Before JP Morgan, spent most of my career in the Bay Area focused on technology, venture, and growth equity. Before JP Morgan was part of Wells Fargo's merchant bank, investing off the balance sheet growth stage companies that were core to Wells Fargo's businesses. So real estate tech, supply chain, food and ag, et cetera. And then before Wells Fargo was part of Samsung Ventures, where they have a fund down in Sand Hill Road, where we focused on, everybody knows Samsung TVs and electronics and smartphones, but they were operating over 80 different business units focused on everything from efficient computing to smart home, health medical equipment, and better battery chemistry and materials. And so had the opportunity from the vantage point of a large corporate investing in a lot of sustainability themes.
Thank you all for being here. I'm going to ask you the question that my mom asked when I launched Venture Fuel, which is, why would a big company care about startups at all? That was her comment to me, and I have a good answer, I think. But I would love from your guys' vantage points. You've been at different organizations, but the question is, is the juice worth the squeeze? Why would companies that are multi-billion dollars of revenue even want to pay attention to some of these early stage ideas? Maybe we'll start with you, Josh, and then we'll bounce around. Yeah.
Yeah, a lot of reasons. One, big companies are good at many things. Being on the cutting edge or moving quickly, sometimes they're not as good at. Working with startups provides an opportunity to get fresh ideas in, provides an opportunity to maybe test out new areas that you don't have buy-in on from a strategy perspective, at least at putting a lot of investment in. And I think it's absolutely critical. It's critical to our strategy, at least. When we look to build out ventures, we don't want to do everything from scratch. So there's different models of venture building. Some are, you look at Alphabet, very R&D focused. They build out Waymo, obviously incredible, what they do, but that takes billions and billions of dollars. And there's other paths you can take to get to market faster. That's kind of how we approach it, by working with startups, by partnering, by potentially looking at those startups as acquisition opportunities later down, or just opportunities to maybe license some really innovative technology. So there's a number of ways, but I think the ability to move quickly, the ability to gain access to really innovative cutting edge technology, especially in software or in areas like AI, which is one of our focus areas that's moving so quickly, that's key.
And what about you at TDK? You have a number of ways of looking at this, but do you have anything to add to that?
Yes, I would say that part of it is learnings. The way we think about the startup ecosystem entrepreneurs is that they are at the cutting edge of what's happening outside the organizations. So there are these big mega trends, as they were mentioned. There is decarbonization, there's new versions of computing. So you can think of this as waves. And every wave, it's either an opportunity for a corporate, or it could be a threat for a corporate. But at least having those insights allow the corporate to make a conscious decision on how they are planning to move when this is all happening. So one aspect I will say is the learning. The other part is also partnerships. For us, being able to partner with startups that are what we call king of the hills, the leaders, that we expect them to be the leaders, it's an opportunity to ride along and be a partner to the startups and create value for the startup. And at the same time, it's also creating value for TDK.
Min.
My colleagues mentioned a lot of the key things around window to innovation. I think access to talent is another really interesting aspect. A lot of these large companies, they have, especially in Silicon Valley, where talent is so competitive, being able to get exposure through startups, high quality world-class talent is a really interesting way to get exposure to that sort of thought leadership. We've seen that play out in a bunch of different contexts. M&A hedge, I think, is a really interesting aspect of how corporates leverage startups. And so as one example, we have a portfolio company called MindSense, where they're helping copper miners, the largest copper miners in the world, be much more operationally efficient. Literally help them find copper in their mines they couldn't find before, which has real impact to the P&L. and at the same time, reducing the GHG emissions intensity of those mines by up to 75%. And so the real ROI that these startups are providing, they're very tangible, and they could materially impact the P&L and the business in a very significant way. And without exposure to that sort of innovation, they would have either been trying to build some of those capabilities in-house, which fill in the blank how much R&D investment and time and talent is required to get there, or they would be searching far and wide to figure out other solutions. And so I think the investors on this panel, I think we're obviously motivated to kind of bring the best-in-class companies in front of those corporates for those reasons. And I think generally corporates that are on the front lines of thinking about innovation, they're very receptive to that.
So let me flip the question. We have a number of founders in the room that were just some featured on with the awards, the top 100. What's in it for an early stage founder to work with a large organization like yours? And maybe we'll start with TDK.
So I will say that's a great question. That's something that the startup should think, the idea should start coming from themselves is, what does a startup need? You probably need customers, you probably need partners, you probably need certain level of engagements, proof of concepts, trials. So there are certain corporates that will be a good fit for you. For example, TDK has a lot of factories around the world. So if you're a startup that has some industrial related product software, why don't reach out to someone like TDK that has those factories? They have the interest in bringing new solutions to the problems they have. And yes, it might translate into an investment or not, but it could still be a way for the startup to validate its ideas or have early engagements and generate value for itself. So that's one way that even before an investment, a startup could find value in engaging with a corporate. Now, post-investment, I will say there are a couple of other ways that a startup can gain value by engaging with a corporate. As was mentioned, talent. You can think of the talent that a corporate brings is huge. And in the case of TDK, we have huge talent around processes, manufacturing, miniaturization. So if those are things that you're looking for, having TDK as a partner is something that will be of value for you as a startup. Also, it will be around potential customers. So if you can identify a customer that have a corporate that have access to the customers that you're looking for, that will be another value you could get by partnering with a corporate.
And Min, what about you? Do you guys go beyond the check? Is there value beyond the capital piece?
Yeah, that's a huge part of our value proposition that we try to make very tangible. And so to the question, the way I try to simplify it, why entrepreneurs should care, it's scale, you de-risk your business, and you get to your milestones. So you could either raise that incremental pool of capital that you need to get to your Series A, Series B, whatever it is, or you get to a potential exit path if that's where your business is headed. Ultimately, you have a TDK or an LG or JP Morgan either on your cap table or your logo list of customers. Investors are going to see that as validation, and that's going to be very meaningful in terms of moving the conversation forward, whether you're trying to win additional customers or you're trying to get that incremental investment from investors. And so I think there is market validation in terms of why it makes sense to work with some of the largest corporates in your ecosystem. And of course, that really depends on what category and space and sector stage you play in. And so don't want to be too broad in terms of how that applies. And from JP Morgan's standpoint, one stat I'll share is we cover over 90% of the Fortune 500. And so when we're on your cap table, what we try to do is we're usually investing in companies where they're at that inflection point of growth. And so you have some revenue, you've proven out you have a product that customers care about, you have unit economics that make sense. Can you leverage a partner like JP Morgan where we can walk you into the doors of C-suite level executives at some of the largest customers that you want to get access to? And then we help grow your sales pipeline and funnel and bring down the time to market for your business. And so that's a very tangible, low-hanging fruit way that we try to leverage the broad scale and resources of the firm. And so far, we've been able to execute on that within our portfolio.
It's funny, when I launched Venture Fuel, the name actually came from talking to a founder who was on what I'll call the hamster wheel of raising money. Every time I talk to him, I'm trying to raise my next round, my next round, my next round. I was like, yo, there's a better way to fuel your venture. You need to go get some deals. I was like, go get commercial revenue. And the comment before from JP Morgan of like, there's debt, there's equity, and there's a third thing, which is revenue, right? Like that was like, that's it. It's like, there's commercial deals. And by the way, when you then go raise money, the power dynamic has changed because you have Fortune 500s on your, as your customer list. And so there's reasons to believe, and it evolves from there. What would you add from that? Because you guys have such a unique approach at LG. You've got a couple different ways to engage, but why would a startup be interested in working with someone like you?
Yeah, there's a number. I mean, I'll echo a lot of what was said, but commercial deals is obviously, something they're very interested in. They, look at us from a customer perspective, from a partner perspective, as we build out these new ventures. That bringing in a startup technology maybe that to be core to that, obviously could catalyze, their business in a way. Then funding is something that they look for as well, and it can be valuable, especially thematically within an industry, to have a strategic on your cap table, and so that can help them with future rounds as well. And then validation. Startups are looking for feedback, and they're looking to show and proof points that will help them raise the next round, will help them get other customers. And so having a large corporate, whether it's a pilot or as a customer, is a validator and can be quite helpful.
So we have a number of investors in the room. And one of the things that we think of, especially from an angel investing community, is once we've made an investment in a startup, how can we help them beyond the check that we wrote? Do you have any advice for the investors in the room on how to help the startups get deals with company like yourselves? And Min, you gave me this question when we did our briefing call, so I'll let you go first.
Yeah, a lot of different ways to be proactive here. I think ultimately, as you think about what's in your portfolio, I think one, being very thoughtful about how to present your founders to corporates. And when I say how to best present, it's really making sure that it's stage appropriate. And so in my view, I think there is such a thing as being too premature in making introductions. And so making sure that when you are making an introduction to a founder in your portfolio, he or she is prepared to present something that's actually compelling for that corporate to engage in a very actionable way. The worst case scenario is you make an introduction to a corporate and everybody has a productive conversation, but there's very limited near-term action items to follow up on, and that relationship quickly becomes stale. And then now you're putting the onus on your founder to really re-engage that relationship in a thoughtful way, which becomes all the more challenging in a sea of many, many introductions that a lot of these corporates are managing. And so making sure that you're thoughtful about the right stage and inflection point in the business for the founder to engage with the corporate, I think is really critical. And then two, I think really understanding alongside your founder, what are the key value proposition points and KPIs that you can leverage to get strong engagement from the corporate. And so in the case of my strategy, we care about solutions that are driving real tangible sustainability impact for the industries and customers that they're serving. And so in the prior mining portfolio company example I shared, if you're trying to get us to engage, you're highlighting all the elements of growth is strong, quality team, everything that most investors care about. But then it's also leading with, here are the tangible ways that this product or service is mitigating climate in this part of the market. And here's why it has adjacencies to this other part of the market. And so crafting that story in a very compelling way helps shorten the cycles to get corporates or investors engaged. And so I think just spending a bit more energy and time in crafting that narrative would be extremely effective.
Do either of you have anything you want to add on that?
One thing I might say is, Yeah, just completely agree. I think being thoughtful of the stage, the timing, the thematic areas. We work with a lot of investors to identify startups, and we end up moving forward with a lot more when the investors are just really thoughtful and they understand kind of what we're focused on and what we're trying to accomplish, what we're looking for, and then also the stage. We get some folks that just send us like a bunch of startups that maybe they're too far, they're too late, too early, or they might be in healthcare or clean tech or AI, but not within the areas that we're really looking. And so I fully agree with what you said.
Yeah, so to what was mentioned is understand the audience, understand what the corporate is looking for to the best of your ability, and also be mindful that we're talking about the corporate as if it is just one person. Yeah. But a corporate usually has multiple business units, multiple groups within the business unit. So identifying who to reach out within the corporate is also very important, because some teams will be more open to these cutting edge ideas, while some other groups will be thinking about delivering results for the next quarter, and engaging with a startup is not their top priority. So also think about, are you engaging with the right team or person within the corporates?
So I want to be actionable for the people in the audience here. They're going to look at startups pitching after this. What advice do you have for the investors in the room for vetting these startups, for deciding if a deal makes sense for them? And you guys see hundreds of deals a year, probably even more. And sometimes these companies sound good. They say the right things. They all have AI in their name. And so how do you make sense of it, right? Do you all have any tips for the group here when they're evaluating these, whether to say yes or no, knowing that it's specific each time? Why don't you go first? We'll go right down.
So I would say have a hypothesis of what you're looking for. I will start with that. So if it's something, just to pick AI, what do you think a company needs to bring in some particular vertical of AI to be successful? You need to have that belief, or that set of beliefs, to be able to then say, oh, this company is hitting the marks or is not. And one way to craft that belief system is to define operating categories. There are certain things that you're very certain about. There are certain things that you believe, but you're not really certain about, but that you have a strong belief about. And there are a couple of other things that you don't really know. But having that clarity on what falls under each bucket helps you then define, I think that the startup that could be successful in this area has to meet this certain set of characteristics. But having this framework of what you know, what you believe, and what you don't know will help you formulate this investment hypothesis. So that will be my first advice around that. And I'll pass it to the rest of the panelists too.
Yeah, I mean, I agree. I don't think there's any kind of magic formula. It obviously depends on investment thesis, but on our end, we found just focus is really helpful. My background is, almost entirely healthcare technology. And those deals, when we're working with those startups, I am, heavily involved, and I have a very strong thesis, a very strong perspective. But if it's a clean tech or maybe a, general AI company, I have thoughts, obviously, but I really look to the experts. And I think that focus is really important, because the more focused you are, you begin to, see trends, and you begin to better understand the space and who's really standing out, what's unique and what's differentiated. And then other than that, it's kind of, the basics. The team is obviously critical, past track record, proof points, whether it's customers, other investors. I think everybody knows those things.
Yeah, especially at the early stages, that if the company doesn't have any traction, so there isn't that proof point that you can say about the company. So the track record of the founders really speak a lot about, you can extrapolate to their ability to deliver in their future initiatives. And think of the team as not only what they've done, but do they have the grit to go through the difficult times and the passion to keep pushing forward when things get difficult? Try to assess that, because the startup is a journey of ups and downs. And if they don't have that grit and that passion, then it's harder.
So we're going to get ready for a question or two. We're running close on time, but I definitely want to open it up to the crowd. I will say one thing, and then I'm coming to you, that's really interesting about Angeles. If any of you are prospective members, what I've found to be very powerful is I might not be an expert in the startup that is pitching, but there are people in this room that have an expertise in whatever that is. And because of the different tools we have to talk to each other, that person becomes a louder voice and can say, this is why this is interesting. This is what I've seen in my career. And so it's a great way to learn about an industry. And by leveraging the network together, we all can become experts on different avenues that might be interesting.
Yes. My name is Jennifer Garcia. I'm the COO for Latino Business Action Network. We run a startup accelerator through Stanford University. We're currently in the midst of our program right now, and we have a professor who is one of our lead professors. He is writing a book on venture mindset based on research around VC and corporate VC. And in one of those lectures, he talked about he shared some words of caution for the founders in terms of working with CVCs, because there are experiences where founders might go into due diligence only for the corporate to learn and walk away, or to acquire and kill. And so I think you all shared some very positive things in terms of what it is like and what the benefits are of working with corporates. But maybe from the perspective of a founder, if you can put yourself in their shoes, is there any words of caution that you would give to founders who are aspiring to work with corporates but might need to be aware of some of the challenges?
I might give a 30-second answer, and then any one of you that would like to. At Venture Fuel, we've done over 100 of these types of programs with corporates across all different industries. And that is a fear of many, many founders. Is my IP going to get stolen? Am I going to be in a conversation for 18 months and it goes away? I think the most important thing is to align what the corporate goal is. Why are they thinking about this? Is there an outcome? And does that match up with what your outcome is as a founder? So if the corporate is not telling you why they're talking to you, what their aspiration is, what their long-term goal is, they might not know. And that's a red flag, and you should not waste your time. If you can understand what their value is that they're going to get out of it, and then position your company as such, it becomes sort of a win-win opportunity. But making sure you know why they're interested in you. But we've done this for 10 years, and I can think of one example where the startup did not get treated properly, and it got rectified actually to the startup's advantage. But there are a lot of sort of scary stories about it, but we've not seen it. And a lot of it, though, is just making sure your goals are aligned. Do you guys want to add anything?
Yeah, I would say, we are very thoughtful, and we would not engage in kind of practices like that. But I would say there are pitfalls. Like sometimes we're not the fastest, and that could just be based on timing, cycle, focus area. Sometimes there's a really interesting startup, and it's an area we're looking at and we're thinking about, but it's really 6 months before we're really at a point where we're going to double down and engage with them. And that can be frustrating to startups. And so less probably on the investment side, but on the partnering, working with corporates, it's not always super quick. And we do our best on that for sure. But it's something that the startups should be aware from. And that can be challenging for a startup too. You don't want to take up time. They have to move quickly. They have limited runway. And so, CEOs should definitely weigh those things when they're engaging with corporates. And some are better than others about that.
It's also, if you're serious about scaling as a founder, and you want to sell into these types of companies, that's the business cycle. So you also have to think about that. Like I know in fintech, founders are like, oh, it's going to take forever. I'm like, yeah, you're going in the most regulated industry there is. Yeah. Of course, if you want to build a company in that industry, be ready for regulation. Go for it.
Yeah, I guess I'll just speak it out.
Yeah.
So it's in a similar vein, a curiosity I've always had about sort of corporate venture is how much are non-competes or exclusivity a part of your situation? So for example, if I work with LG, am I allowed to work with Samsung as a client, right? Is there any exclusivity or non-solicits or non-competes that are part of your formula?
Yeah, I can speak to that. I think it depends. And I think large companies sometimes try to take that route. We've tried to push back on it. However, Samsung may be an exception for LG because it's like the direct competitor. And so it depends on what it is. If you're investing, maybe a little different. But if we are licensing IP that we think is very unique and it's critical to something we're building, we may care a lot more, not about everybody, but about a direct competitor. So it's maybe case by case. But I do think it's better when the corporates try to have total exclusivity, especially when they're an investor as well. It hurts the startup, and I just don't think that's fruitful and wise. So,
yeah, I just want to clarify when we're talking about engaging with a corporate, can be from an investment side of things or can be through the parent company directly. From an investment side, it's, at least for us, we don't expect any just exclusivity agreements, because for us, having an existing engagement with the parent company, it's not even a prerequisite for us to invest. But engaging with the corporate, as I said before, like each part of the corporate might have different ways of working, and you have to be mindful and just ask about it. What are the timelines? What matters to them?
It's very interesting. A lot of the large corporates have like a legal playbook that is literally like a non-compete. It's just like the lawyers get it and start with that, and they throw it out and see if you're going to sign it. Just because, why not? Not to say that any of these guys would do it, but it's the business person you're working with isn't thinking that way. So oftentimes you can push back and say, hey, wait a second, this is a $100,000 deal or a $50,000 deal. No way. And they'll be, oh yeah, we don't care. That's fine. Sometimes if it's very IP or it's very competitive, they'll ask for it, but then you'll be compensated for that. Yes, sir.
Yes. I do have a question similar to how entrepreneurs partner up with your organizations. How do investors, or how do you see partnering with other like VCs? And for a little bit of context, I have a group called Marvin VC. We actually partner with a consortium called 5G Innovation Lab. You might have heard of it or not. Great consortium, Microsoft, AT&T are all part of it. And yeah, my question is your perspective as a corporate VC, and how do you collaborate with pure VCs? What are some tips there?
Yeah, I don't want to jump in, but you feel free if not.
Sure. At least from my side, the way I look at it is that the VC industry is a community. It's rarely the case that you will have just one VC that is going to take the whole round and do it for every single round. So it's a community. So we have to play with other members of the community, collaborate with other players in the community in every shape, way, or form. And it's also a way that we learn from each other's expertise. Like you might have an expertise in healthcare, so I might come across a startup that is in healthcare. It's not something I'll look at, but I can send it your way because it might be relevant to you. So the way I see it, there's a lot of collaboration among VCs and corporate VCs.
VCs also love the CVC perspective because they have the client view also. So it's a validation. But it's a community. You all know each other. They all talk to each other. They work together.
So. Yeah, would agree. Also, on top of, we look for other partners. We don't always lead. We generally don't lead deals, actually, not that often. So we want to work with other VCs, but also from a portfolio perspective, we source a lot of startups by working with VCs and looking at their portfolios. So
that's right. Last one.
Samuel, how should startups think about taking capital from strategic corporate investors in terms of percentage of ownership? And also even potential board seat. The reason I ask is early on we got a publicly traded company to invest in my company, and we thought we'd been very thoughtful, but we purposely took a very minimal investment from them and gave them no board seat as a result of trying to ensure we had no conflict of interest on the strategic direction of the company. But curious to get your thoughts.
Yeah, I mean, on my side, I think it's case by case what you do and what the competitive advantages are, and is that having that corporate heavily involved and on your cap table, is that going to keep you from working with their competitors? And even if there's no non-compete to the other question, if you have Disney on a cap table, Comcast is going to look at you a little differently than if you don't. So it just depends. And if that's your person that you want to acquire you, go for it. So I think it's a little bit of a balance in a case by case, but for the most part, you can navigate that. Like they're pretty comfortable. they want you to have a win-win situation because that's the only way they're going to get a return on investment. So it can be a collaborative discussion with them. You're going to be with them for 7 years. It's like a marriage, any investor. So you have to be honest up front.
Great, thank you.
Thank you all so much for having us. Thank you guys. Great job.
Thank you, Fred.
Yeah.